now. Okay, so what we're going to do is go through one of the practice midterms, practice finals, I guess, at this point. And it's this one. I think this is number 3. I listed as number 3 up there on iLearn. Is that right? Does anyone know? Yeah, one of them's a duplicate. Huh? This is 1 or 3, however you want to look at it. It's the same? Yeah, okay, so yeah, 1 and 3 are the same, so there's really only what? 2 practice midterms up there. But remember, I'm going to put another one up there that's not going to have the answers. Probably going to be about 15, 20 questions, so we have time to work through those independently, and then we'll go through them together. Okay, so there'll be another one coming up, but there won't be any answers to that one. There will be answers, but not highlighted, and then we'll go through it together. Okay? All right, so let's go through this question here. A not-for-profit voluntary health and welfare organization. Let me get myself on pen mode here before I get too far with this. I think red is good. A not-for-profit voluntary health and welfare organization received a $500,000 permanent endowment. Okay, that means it's a what? Permanently restricted contribution, right? The donor stipulated that income from the income must be used. This is income from the investment. Must be used for a mental health program. The endowment fund reported 60,000 net decrease in market value and 30,000 investment income. The organization spent 45,000 on the mental health program during the year. What amount of change in temporary restricted net assets should the organization report? Now, the thing that you need to start getting used to for questions like this is use the mechanism of the statement of activities to help you solve through this, right? So what I had students over the years that say, I don't understand anything that's going on with these questions, and I sat with them and I go through question after question, walking them through the statement of activities and how it works, and then it's like, oh, okay, once you practice with these enough, you understand them, okay? So you come over, and I'm going to just put a little statement of activities. I'm just going to draw a statement of activities in here. Okay, this is a statement of activities. And let's just put the transactions on the statement of activities. So we got a what? Contribution of a permanently restricted. So it's going to be either unrestricted, temporary restricted, or what? Permanently restricted. And this one was a contribution first that came in permanently restricted for 500,000, right? Okay, good. Then what? Then they tell us that we had a decrease in market value, didn't we? Okay. But they also tell us that there was 30,000 investment income. So I'm going to go ahead and I'm going to put my investment income. And since the donor said it had to be used for a mental health program, I'm going to go ahead and put it where? Temporary restricted. Good, for 30,000. That's for the income, right? Then they tell us that the organization spent what? Spent 45,000 on the mental health program. So since they spent 30,000 for the mental health program, then I have to reclass that out of temporary restricted, don't I? So I'll report the reclass adjustment by doing what? Showing the money coming out of temporary restricted and going into what? Unrestricted. And then I simply report the expense. How much did they spend? 45,000 got spent. And of course, I'm going to run out of room. I still have to deal with what? The 60,000 decrease, right? Which would have come from the temporary restricted if there was what? Anything left in there, which there is not. So I have to report that loss, and that loss comes out of where? Good. Comes out of the unrestricted, because that's all that's left, right? That's the 60,000. That's a $60,000 loss that came out of what? Came out of what category? Unrestricted, right? Does it mess you up that much that I wrote the 60,000 over those words? That's a 60,000 loss that came out, right? Out of the unrestricted. Okay, and so the question says, what amount of change in temporary restricted net assets should the organization report? Answer is what? 0. It came what? Up by the amount of investment income, but we used all that the way the donor specified, right? And since that entire amount had been used up, there was nothing left to absorb that loss. That loss went to unrestricted, right? Okay? Hello? Question? Okay, good. I'm going to go ahead and erase that 60,000 now that you've seen it because I can't read the other question. So I want to get rid of that. But you've got that now, right? Okay. You asked me after I erase it, but go ahead. Wait a minute. Let me put it back. Well, that would have ignored the first of all, 30,000 isn't a choice here, so I'm not sure how you would have chose 30,000 because it's not a choice there. But I don't know. Are you saying 30,000 increase or decrease? You would have wanted to choose if that was there as a choice, which it's not. You said that you would have said 30,000, and the problem is specifying increases or decreases. So were you thinking 30,000 increase or decrease?
I would have thought 30,000 decrease since I would think because I transferred it to unrestricted. That's how I would have interpreted it.
So why would you have ignored the 30,000 that came in on the investment income? So 30,000 came in on the investment income. Guys, don't overthink this. Look up here. 30,000 came in on the investment income, didn't it? Right? And we used it the way the donor said, didn't we? So when we use money the way a donor says, we have to reclass out of temporary restricted and into unrestricted, right? The fact that we used more on the program than what was available from what the earnings were is of no consequence. Look, we're going to spend what we're going to spend on the program, aren't we? We're not going to limit it to 30,000 just because a donor told us to spend money he gave us on our program. The donor didn't create the program. The program already existed, right? And the donor said, spend it on this program. Okay, but we got to spend 45,000 on the program. So we were what? We had 30,000 available, so we reclassed that out, didn't we? And put that into the unrestricted column. We spent the 45,000, and then what? Then we had that loss on the investment. We would have taken the temporary restricted if there was anything there, but nobody's home. There's nothing there, right? So where do we go when there's nothing left? In the temporary restricted column, it goes to unrestricted. This is just like we did before. The only difference was some money had come in. Some of the money that had come in got used up. The money that had come in got used up, didn't it? Other than that, it's exactly that example we went through with the bagel ovens. Okay? Okay. All right. At the beginning of the year, the Baker Fund, a not-for-profit corporation, received a $125,000 contribution to youth activities. During the year, youth activities generated revenue of $89,000 and had program expenses of $95,000. what should be reported as release from restrictions? Again, guys, the way to attack these is to sit here and just make yourself up a little statement of activities that does what? That sort of walks through the transaction. Okay, so let's just make ourselves up a little statement of activities here. And we have contribution. Contribution comes in unrestricted, temporary restricted, or permanently restricted. And they tell us that there was a contribution that came in restricted to youth program activities. So what is that? That's a temporary restricted contribution of 125,000, right? Okay, good. Then they tell us that we generated revenue of 89,000. If we generated revenue, what does that mean? That means it is automatically considered what? Unrestricted. If we work for the money, it's unrestricted. Donors can't restrict how people who get our service in an exchange type situation can't then tell us how to spend the money that they paid us for the service, right? Okay, so that is unrestricted. Then they sit here and they tell me that they had program expenses of 95,000, so we can use that money that the donor gave us, can't we? So when that's the case, we're going to have a reclass in which 95,000 is going to come out of the temporary restricted and go into the unrestricted. And then we report the expense of what? Of how much? Huh? Of 95,000. Good. I thought I heard you say something else. 95,000? Right? Okay. So the what? Assets released from restrictions was how much? 95,000, right? Okay. So again, you look at this and they give you the whole story and then they just isolate one part of the statement of activities, don't they? So the way to attack these is just take the whole story, run it through the vehicle of the statement of activities and see where you end up, right? Don't make up rules. If you're having trouble with this, it's because you have not turned off the creative side of your brain. You need to turn it off, and you need to sit there, and you need to just use the rules that we've discussed, which is what? When a contribution comes in with a donor-imposed restriction that can be satisfied by some action of the organization, like using it for a program, it is temporary restricted. When we meet the what? When we meet the donor's requirements, we do what? We reclass for those portion of the proceeds that the contribution that we have met the requirements for by reclassing it out of temporary restricted and putting it into unrestricted. All expenses are by definition unrestricted, and then revenues are by definition what? Unrestricted. Those are the only rules. The rules that are bothering you are ones that you made up, which is, well, wait a minute, we got 89. Don't we have to spend the 89,000 first? There's no rule like that. As you meet a donor's restriction, by spending the money. Doesn't matter if I had $10 jillion available for this program. I met the donor's requirements. I do what? I take it out of the temporary restricted and I put it into what? Unrestricted. Yeah. It's unrestricted. It's unrestricted. Now, there could be some, only donors can restrict. Only donors can restrict. Now, there could be an action by the board of directors in which the board of directors designates that any money that is raised in revenues for this program are used for this program, but that is still considered unrestricted, and it is then would be designated for a specific program, but it's still unrestricted. Okay? Okay, good. Let's go ahead and let's take a look at this next one.
Quick question.
Uh-huh.
When it says what amount should Baker report as net assets released, are they basically saying what was taken out of the temporary restrictions? Is that basically what they're saying?
Yep. They're looking at that part right there. Yeah. It's released from its restrictions. It's now going into unrestricted, out of temporary restricted. Okay, good. So let's go ahead and I guess it could happen, but it's very rare that anything goes out of permanently restricted and into temporary or unrestricted. It could happen. A donor could change their mind, right? And it could happen that it would go out. Not in this class. And in a really, 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 really weird situation, you could have something that was unrestricted that somehow ends up getting restricted, but that would be bizarre. That would have to involve agreement of the not-for-profit to take funds that were what previously given an unrestricted, stipulations, and now what stuck into temporary restricted. The not-for-profit would have to agree with that retroactively, right? And the only situation I could think of that might cause that is if there was some sort of misunderstanding on the part of the parties at the time, and now they said, no, I wanted to be used, and the not-for-profit said, okay, if you misunderstood, then we're not going to be an idiot about it, and we'll go ahead and we'll move it over. But if you did something like that, that would really, I think, involve a restatement, okay, because that's not a change in estimate. That was just, an error that was made through misunderstanding. So anyway, that would be really weird if that happened. So typically, Yvetta, the only reclasses that we're seeing is out of temporary restricted. In this class, always, it's out of temporary restricted and into unrestricted. Okay? Okay, now you come over and you take a look at number 3 here. In the year ended June 30th, 2015, Barr College, a large institution, received $100,000 designated for the donor by the donor for scholarship of superior students. So here we go, another statement of activities type question, right? So when you get that, you go ahead and you make up yourself a little statement of activity action over here, right? Okay, statement of activity. And the amounts come in what? Unrestricted, temporary restricted, permanently restricted, and we had a contribution. And this is what, 2015 in this example? Right? We had a contribution that came in what? Temporary restricted, good for the scholarships, right? Okay. Now, they say the year ended June 30th, 2015, and they say on July 6, 2015, we're into the new fiscal year then, aren't we? If the old fiscal year 2015 ended on June 30th, the new fiscal year must have started July 1st, right? So they're actually awarding the scholarship in the next year. So now we need a 2016 statement of activity, don't we? Hello? Okay. So we got the 2016. I'm just putting it up here so I don't have to write over the information there. That's 2016 statement of activities. And in 2016, I awarded the scholarship. Is that what happened? So if I have unrestricted, temporary restricted, permanently restricted, I'm going to have a reclass, right? And in 2016, the money will come out of my temporary restricted, 100,000. I know I'm creeping into the permanently restricted column here, but that's not permanently restricted. Let's put the permanently restricted way over here. Okay, so it's coming out of what? temporary restricted, and then what am I supposed to do? Put it into the unrestricted, right? And then I'm going to have the expense, right? For 100,000. Is that what's supposed to happen in 2016? Right? So they tell me, how should the July 26 transaction be reported in BAR's statement of activities for the reporting year ended June 30th, 2016? That's the 2016 statements, right? They began July 1st, 2016. July 1st, 2015. It ends June 30th, 2016, right? Right? Okay, and so what happens? It is both an increase and a decrease of 100,000 in unrestricted net assets. Is that correct? Did it increase the unrestricted net assets for the reclass? Did it decrease them for the expense? Okay, this is the save the canines example. The simple little example that everyone understood. What happened? I could have said $10,000 came in 20x1, whatever it was, year one, and then what? Then the monies were spent in 20x2. How should the transaction be reflected in 20x2 statements? It would be both a increase and decrease in the unrestricted net assets of $6,000 in that example, right? Right? Okay. Okay, good. Let's come over and let's take a look at number 4. The Jones family lost its home in a fire on December 25th. Lost its home in a fire. On December 25th, a philanthropist who wished to remain anonymous sent money to the Omer Benevolent Society to purchase furniture for the Jones family. So what happens? The donor comes up to this not-for-profit, says, I don't want to be known. Here, take this money, but give it to that other beneficiary, right? So Amir is the recipient and the Jones family is the beneficiary, right? Okay. And so what's happened? How should Amir report the receipt of the money in the financial statements? And that is a what? It's a liability because the donor did not grant variance power to the Benevolent Society. They said what? They said, here's the money, but hand it to somebody else, right? Okay. In a statement of activities, depreciation expense should be recorded as an expense, you think? I mean, all that's testing is, do you remember we're on full accrual accounting and we'd be using depreciation, right? Okay. Okay, good. Now remember, on our statement of activities, when we report our expenses, we have program expenses, which are things the not-for-profit does, and then we have what? Support expenses, which are things the not-for-profit does to survive. Classic examples are administrative expenses and fundraising, right? Okay, so you look at this question, and they're asking me, well, which of these would be relevant to fundraising? And printing of an annual report and getting a CPA firm to come in and do some work for you are administrative costs, aren't they? Okay. The only thing that's fundraising here is, sending money to people to encourage contributions. That is the sheer definition of fundraising, isn't it? Having an annual report and having a CPA audit is not fundraising. Okay. So the answer is what? Just the fundraising? Okay, good. Number 7. Okay. And when we look at number 7, we say that they have an experience that 10% of all their pledges will be uncollectible. And somewhere I must have left out a dollar amount on this. I guess I lost it in the cut and paste. But What I can tell you, just from looking at the numbers and having looked at this before, is there must have been a donation, a pledge, I should say, of a donation. A pledge is receivable of 350,000. But remember, we said last time that with a donation, if there's a percent that is not collectible, you reduce the contribution by the amount you think you're not going to collect, right? Remember we said that last time? Okay. So if we're sitting here, we would have done what? We would have debited contribution. And if we're not going to get 10%, that means we're not going to get 35,000 off of that, right? So we would have credited contribution 315,000, which is the answer to that. And we would have credited what? Well, I guess they didn't ask me contribution. Allowance is what? 35,000. So when we report the pledges receivable on the balance sheet, pledges receivable is how much? Pledges receivable is how much? 350,000. The allowance is how much? 35,000. And so the net receivable is 315,000. Right? Right? Is this how you would treat this in commercial? Is this how you would treat this in commercial? Anna, is this how I treat this in commercial? Okay. I've thrown that pitch past you guys all three times. Every time I've asked that question, you've swung and missed at that question. Okay, this is not how you do this in commercial. And Anna, I didn't mean to call. You were looking to me like you were going to say no. That's not how you do it in commercial. So I didn't mean not to call you out like that if you didn't know. But what's happening? That's not how you do this in commercial. If I determine that 10% of my receivable is not collectible, what am I supposed to do? Good. I would set up a bad debt expense, right? So when I have a sale, this is commercial, debit accounts receivable, how much? For 350,000. Debit account receivable what? 350,000. Credit revenue for what? 350,000. And if 10% is not collectible, I'm going to fire my collection department. But other than that, debit bad debt expense for what? Oops, 35,000. And credit the allowance, right? So I don't reduce the revenue by the amount that's going to be collectible. I set up a bad debt expense, don't I? Right? In not-for-profit, I reduce the revenue by the amount that I think I'm not going to collect because remember we said that if I reduce the contribution, I should say, by the amount I think I'm not going to collect because remember we said that if a donor gives us a conditional promise, we don't take the revenue for that, right? And if the donor has decided not to send in the contribution, apparently they must have decided that they had some condition that we haven't met, right? And so we reduce the revenue by the amount that we're not going to collect because that is almost like it was a conditional promise to give. You say, well, wait a minute, the donor hasn't told us there's a condition. Yeah, but our experience is that donors have a condition that they don't articulate to us, right? And so we reduce the revenue by the amount we're not going to collect. The contribution by the amount that we're not going to collect. Now, let me ask you this. What if this was a service that the not-for-profit provided? We provided a service. So we did some doggy grooming and we billed the people and they weren't paying us. Now what? Huh? Yeah, now we go, you can kind of see the way I set that up. Now we go to this model, don't we? So if a not-for-profit is providing a service, a charge for service in an exchange type situation, they use the commercial model, don't they? If it's a contribution, they kind of do it like we said with government, reducing the revenue by the amount you're not going to collect, although it is for a different reason. With government, it is the measurable and available criteria that drove us to do this. With what? With not-for-profit, it is this conditional promise to give that caused them not to send the money in. Even though we don't know exactly what that reason was, we still would have to reduce by whatever our experience indicates we won't collect. Okay? Okay, good. Take a look at this Midtown church. And they received a donation of a marketable security from a church member. The securities had appreciated in value after they were purchased by the donor, and they continued to appreciate through the end of Midtown's fiscal year. At what amount should Midtown report in its investment in marketable securities at the balance sheet date? And it is what? The market value at the balance sheet date. We treat everything as a trading security, market to market, right? At 12/31, whatever the balance sheet date is. Okay? Okay, good. Number 9. When a not-for-profit organization combines fundraising effort with educational materials or program services, the total combined costs are incurred between what? Are allocated, I should say, between what? Fundraising and program. Remember we had the doggy grooming class for education, and we said, hey, we had to spend whatever it was, $1,000 on the class, and 10% of the cost was going to be program, and the remaining 90% was going to be fundraising. Okay. Okay, good. Number 10. An unrestricted cash contribution should be reported in governmental not-for-profit organization statement of cash flows as operating activities. Unrestricted contributions, we said, go where? Unrestricted contributions go to operating activity, right? If you don't remember, go back and look at the video. I don't know what to tell you. We went through that in the last chapter. Operating. Okay? Now, not last chapter, but the last lecture, the first part of this chapter. Okay? Now, what happens? If I receive a contribution and I am supposed to use that for equipment, where does that go? Huh? That goes to investing, doesn't it? Right? What about when I buy the equipment? That money comes out of investing, right? So if I get a donation for long-term purposes, in as financing, out as investing, right? Use of cash in investing. Okay. Okay, good. So let's take a look at this next question, and not-for-profit number 11, or I guess this is 10B. I got two number 10s here. Well, this is the unnumbered question, however you want to look at it, but this is a different question. A not-for-profit voluntary health and welfare organization should report a contribution for the construction of a new building as what? Financing activity. A building is a long-term asset, isn't it? So when you receive money restricted for the use for long-term purposes, it is financing. When you spend the money, it is shown on the statement of cash flows as what? Investing. I'm just testing your short-term memory here. We just said that. It goes in as financing, and it goes out as what? Investing. Right? Statement of cash flows shows money, cash, that is coming in for different purposes, right? And we group those into three categories: operating, investing, financing. Okay? Our day-to-day operations things go into operating. In not-for-profit, if someone gives me an unrestricted contribution, it goes where? Operating. In not-for-profit, if someone gives me money and it is restricted to long-term purposes, it goes into financing. When I spend such money, it comes out as investing. Okay? Okay, good. Come over and let's take a look at this question. Okay? But before we do, we need to get into chapter 16. So let's look at chapter 16. It's on iLearn. Got it? Hello? Yep. Okay. All right. So let's go ahead and let's take a look at how we will account for hospitals. And the only thing we're going to do here is we are going to talk about revenue. The revenue line item only for hospitals, okay? I'm just going to talk about revenue. Now, when we look at hospitals, of course, they can be for profit or not for profit, right? Hospitals are, covering the whole gamut here. Okay, we're obviously interested in what? Not for profit hospitals that fall under FASB's requirements, right? All right, now, when we talk about revenue, there are different sources for a hospital. Obviously, what? Patient service revenue is considered a revenue as we provide, service to the patient, like this, doctor is providing to this patient. And then what? Then we have third-party payers. This is what? This is insurance companies, essentially, right? And the not-for-profit will also, the hospital will also probably get some money from the government through Medicare, Medicaid, that sort of thing, right? Okay? So all of these are revenue sources. You come over, and the way we account for revenue in the hospital is we report it gross. So we report it at whatever it is we would charge somebody who just came in as an individual and said, I have a broken leg, will you please fix my leg? So in this example, let's say they charge $50,000 to fix a broken leg. That's probably a little bit much for a leg, but whatever. So we're going to do what? We're going to credit revenue for the $50,000, right? Now, the person that comes in, though, tells us that they have Blue Cross, and they hand us their Blue Cross card. So we look into our system, and we find that Blue Cross only will reimburse us for what? Not reimburse us, but will pay us for that service only $30,000. How come Blue Cross gets a good deal on that? Why does Blue Cross get a deal? If you come in without insurance, it's going to be $50,000. But if you come in with Blue Cross, they're going to only charge Blue Cross $30,000 for that. How come? Why does Blue Cross get such a good deal? Huh? It's, well, that's considered charity care. And if that's the case, we don't report that. Huh? Yeah, very good. Blue Cross comes in and says, You want some of this business? I say, yeah. Then for the leg thing, we're only going to pay 30,000, not 50. And the hospital says, okay. Because what? They know that there's going to be a lot of broken legs coming in, right? And so they sit there and they say, okay, that's a good deal for us, right? But from the accounting standpoint, what do? We record the revenue for the what? Customary amount, and then we do what? Obviously debit the receivable for what we're going to get from Blue Cross, and then we debit a contractual adjustment, a contra revenue. It's almost like sales discounts, isn't it? Isn't this what you do in sales discounts? Okay, so we debit that. Now, they do this because what? Their accounting system is probably set up in a manner, first of all, that when they press the button, the code for broken leg fixing, it automatically charges whatever the customary amount is, right? And then when they put in Blue Cross, it probably automatically adjusts the system down to whatever the amount is, and they put the discount. Okay, from a what? From a compliance with the FASB rules standpoint, FASB wants us to keep track of what the contractual adjustments are because we're going to probably have to disclose those somewhere, right? Okay, so that's how you would record that. But when you look at um, the financial statement real quick, and then we'll come back to that other point. When you look at the financial statement for these guys, notice that we report what? We report net patient service revenue. See those little stars right there? See those twinkle, twinkle little stars? Okay. And you come down here and it says revenue from healthcare services reported net of contractual adjustments. And this is not a very good example of a footnote. There'd be more discussion of what the contractual adjustments were, et cetera. So we'd probably have to disclose it in a footnote somewhere. But we're putting it what? Net of the contractual adjustments, right? Now you look at this and you say, well, is there anything else about hospitals? The only other thing about hospitals, other than what I'm going to show you on the other slide, but one of the takeaways is now, because we're talking about a specific type of not-for-profit, is what? Unrestricted, temporary restricted, permanently restricted. Follows the same format, doesn't it, that we've already learned? All not-for-profits follow the same basic format. When we do what? When we have met a restriction, the money comes out of the temporary restricted and goes into what? Unrestricted as it's released from its restrictions. And then what? All expenses are automatically considered unrestricted. So the format is exactly what we've already learned, right? The only thing we had to take away here is issues with revenue. And so far we know that for contractual adjustment, they reduce the revenue down, don't they? For that contractual adjustment? Right? Okay. Now, John, you mentioned, I say, well, that's charity care and it's not recorded. If somebody comes in, okay, we don't let them die. We don't sit there and say, you have insurance? Do you have insurance? No? Okay, see you on the other side, right? We are supposed to do what? We are supposed to sit there and give that person the service anyway, right? But we're not going to get any money out of them for that, so we simply don't record that. Charity care is not recorded. If you provide a charity care, you don't report that as any kind of impact on revenue. Okay, there's no impact on revenue for charity care. Okay? Okay, good. So, with that all in mind now, let's go back. And I have this problem embedded in here. And then last night everybody said, John, that's the same question. Oh, I'm glad I did that. Actually, this one is not the same. The other one's the same. But let's look at this one first. Okay? Now, this one is not specific to a hospital. This one right here is not specific to a hospital. The other one is. It's kind of hard to see, but I'll read it to you. This PICA, a not-for-profit organization, received an unconditional promise of $100,000 expected to be collected within 1 year. PICA received $10,000 up front. 90% of the contribution expected to be collected within 1 year. PICA received $10,000, but only believes they'll collect 90% of their contributions. what amount should be contribution revenue, and it's going to be the 100,000. And since they think they're only going to get what? 90% of that, we report the contribution what? Net of the uncollectible amount, right? Uncollectible is 10,000. With me so far? Okay, now that is for a situation where it was a contribution. If we've provided a service, how are we going to handle that? And this question now, you can go back to the Word file. And let's look at this here because it's a little easier to see, right? Okay, so let's just go ahead and let's take a look. And we have this hospital that has $775,000, okay, from patient revenue, and it includes $25,000 of charity care. Okay, so I've got this $775,000, don't I? But I've got charity care of $25,000. So what do I have to do with that? Huh? To get to they want me to report net patient service revenue. What do you want me to do with the charity care? Subtract that 25,000, right? Well, sometimes students say, well, if they weren't supposed to record it, why is it there? Because this is a test problem, and we want to see if you know to back it out. So there's that 775,000. We're backing out the 25,000, right? Okay. Okay, good. Then what? There's a provision for bad debts of 15. Let's think about that for a second. But let's take a look at difference between billing rates and fees negotiated with third parties. Contractual adjustments are 70,000. What do you want me to do with that? Contract adjustment gets subtracted out, doesn't it? For what? 70,000? Okay, good. Now that we know that, what do you want me to do with this provision for bad debts? Since this was a revenue, since we provided a service, we would not sit there and subtract that to report the revenue net of that. We would do what? Set up a bad debt expense and credit the allowance, right? But we don't reduce the revenue. So we just ignore that, don't we? Unlike if it was a contribution, we would have reduced the contribution by that amount, right? Hello? Okay. Okay, good. So that means the answer here must be 680. Right? Hello? Okay, good. Let's take a look at this one. Okay. Private college provided the following information, and we say what amount of contribution revenue should the college report in the statement of activities. But before we get to that, let's go ahead and look at chapter 15. Which is for the colleges and universities. Okay, all right, so let's just go ahead and let's take a look at chapter 15, colleges and universities. And again, for the most part, we're going to follow the same accounting that we've been talking about for the generically all not-for-profits, right? But when we get to the revenue, and it seems to be revenue where there's a specific call out for the individual organizations, when we get to revenue, we're going to report our tuition gross of what we charge for the tuition, and then we will set up a what? A discount, allowances, scholarship discounts, all of that sort of stuff as a contra against that revenue, right? Okay? So when we report that on the face of the statement of activities for a college, notice we have what? Tuition and fees, and then we back out what? We back out the scholarships, etc. Right? As a subtraction, like a discount. And then we report our net tuition and fees, and then we continue on from there, don't we? Showing contributions that may have come in. Notice that colleges are kind of interesting because in a hospital could work the same way, and that what? We have revenues generating a significant amount of our support, but we also have what? We also have contributions coming in as well, don't we? Okay. But notice the what? The structure is exactly what we've learned. We've got what? Unrestricted, temporary restricted, permanently restricted. If we meet a donor's requirements, we do what? I don't know why it always makes me go through that ritual to come back to where I can write on it. But we have unrestricted, temporary restricted, what? Permanently restricted. When we meet a donor's requirements, we come out of the temporary restricted and go into the unrestricted. So for the most part, this is pretty much what we've already learned. The only thing was different is how do we handle those discounts, scholarships, that sort of thing. We net them off, right? Okay. All right. That's it for the colleges. Not a lot to say there. Just wanted you to be aware of that unique aspect. But let's go ahead and let's take a look back at this question now. Okay, so private college provided with the following information, and they're asking me for what? Contribution on the statement of activity. So I've got an unrestricted pledge of 50,000. Should that be restricted? Be considered a contribution? Is that a contribution? Who said no? A debit pledge is receivable for what? 50,000, and I credit what? Contribution. Now look, there may be some uncollectible amount, but I can't invent something here. They didn't tell me what the amount was, so I guess I'm going to have to go ahead and just credit contribution for the full amount, right? Okay. Then what? Then they say there was a $25,000 cash gift restricted for scholarship, so what should I do there? Debit cash for 25,000, credit what? Credit contribution, right? For 25,000? Okay, so far, what is my contributions? 75,000 so far, right? And then a notice from a recent graduate that named the college as a beneficiary of 10,000 in the graduate's will. Should I record that now? What should I record for this? What kind of promise is this? Huh? Good. It's not called that. It's conditional, but it's based on the inevitable condition that this person will die, but because they haven't died yet, what? We don't record that, right? Until the person what? Dies. Okay, and they didn't tell me they died. They said they notified me. Now, if they said through a seance they notified me or something, then I guess I would have to, take the contribution at that point. But if they've notified me, the idea is that I wasn't haunted, and what? They actually told me that, they're going to give this to me and it's in their will, right? Okay. Okay, good. Let's take a look at number. Oh, we're done? You want to do this last one and then we'll be done? And what we'll do is we will little bit of an audible here. We will start the class next time going through probably about 15 questions that you've never seen the answers to for, and we'll go through those, and then we'll continue to drill. We should have time to continue to drill on whatever we don't finish here on this exam. Okay? Okay, so let's just go ahead and let's take a look at this number 13 then. You want to do this now? Okay, so they say, what is the change in temporary restricted net assets? If they're asking me the change, they're asking me for the statement of activities, aren't they? So when I get a question like that, what do? Draw myself up a little statement of activities here, right? Okay. But I don't want that one because I don't think, even though it's longer, I think I need it to be wider here to fit everything. So, and I don't know why the thing decided to go all the way back up there. And did everything but what I wanted it to. Let me try it this way. There we go. And I'm going to erase that underline too because that's not helping me much. Okay. And so I'm going to go ahead and put it right here, statement of activities, right? We draw our statement of activities. Okay, good. And so let me get back to where I can read the fact pattern now. And we received a $700,000 permanent endowment, right? So we got a contribution. And that contribution is either going to be unrestricted, temporary restricted, or permanently restricted. What do you think? Permanently restricted, right? 700,000. Okay, good. Then the donor stipulated that investment income and investment appreciation be used to maintain its senior center. Okay. The endowment reported a net investment appreciation of 80,000. So what do you want me to do with that? I'll call that gain on investment. Good. That's temporary restricted 80,000, isn't it? Right? Then what? Then the organization, and investment income. So I'll just call that, how about if I just call that investment income? That says investment income of what? 50,000? Okay, good. Then it says the organization spent what? 60,000 to maintain the senior center, which is what they wanted me to use that money for, didn't they? So I guess I better go ahead and put a reclass down, right? And that money is going to do what? Come out of the temporary restricted, how much? 60,000, good. And come into the unrestricted, right, for 60,000? And then I'll report the expense of how much? $60,000, right? So the question asked me, what is the change in temporary restricted net assets? Well, I know there's no expenses that come out of temporary restricted because the expenses come all out of what? All come out of my unrestricted. So the net income for the temporary restricted is going to be the money that came out versus the money that was reclassed out, right? There's no expenses there. And so what is this? 130 minus 60 is 70,000 would be the change in the temporary restricted net assets would be what? 70,000. Is that the answer? Right? Okay, guys, so I would suggest, something wrong there, John? Hang on a minute, guys. Go ahead, John.
The net investment appreciation, so that's applied first. I was just looking at the first example we had done.
Hang on a minute, guys. He's asking a question that you might learn something from, all right? Go ahead.
First prong, does it even make a difference if we had applied that last?
If we had applied the 80,000 before what?
Well, for
We
the
applied it first. If we had applied, what do you mean? Say it again.
because I'm wondering with the first example, we applied net, the 60,000 net decrease in market value. We applied that last. It looked like we didn't even. I don't know why we didn't apply that in order.
There's no the order is the presentation requirement on the statement of activities, and the problem doesn't necessarily spit it out to you in that order. Okay, so what I did probably in that other one. Hang on a minute, guys. Wait a minute. What I did in that other one is I probably took it in a different way than the problem spit it out to us, so that it would meet the presentation order. The presentation requirement would be that the reclass is the last thing that you see before you get to the bottom line total revenues, contribution, and support. Okay, so if you look back at the statement of activities, okay, let's just look at the example statement of activities. I hope is still up from that we were just looking at from the college, whatever. Slideshow from current slide here. Okay, if you look at the presentation order here, if you look at the presentation order, can I get back? Yeah. If you look at the presentation order, John, you get what? You get revenues, tuition, right? And then here's contributions, etc., coming in. And of course, just to make it more difficult for me, the damn thing doesn't have any gains from investments. But if the stupid thing had gains from investments, that would all be there. And then the last thing you see is what? You see the reclass, though, is last, right? And then you have the total that includes net of the reclass, and then your expenses are all unrestricted, right? And so I think what I might have done with that previous problem is just almost subconsciously put it in the order that it's supposed to be presented on there, but the problems don't always spit it out in that order, when they give you the requirements, okay? Okay, that's a good question. That's why I wanted you to hang on and listen. Now, look, um, next time, okay, look for that test on Wednesday or so, okay? No answers going to be on there. Print it, bring it. It'll be about 15 questions or so we have the time to go through those, and then we'll finish working on this example one that we just started today, okay? All right, guys, have a good have a good weekend, and I'll see you next week. Hi.